Okay, first-time home buyers. Next question for Jay. Jay, let's say we've got a household, total income. We've got a husband that's working and a wife that's working. Husband's income and credit looks good. Wife's income or maybe credit is not good and would drag things down. How do you deal with that?
Okay, this happens all the time. Not everybody has the exact same credit scores. Even if they've been married for a long time, they have some different debts, whatever. I like to look at all the time is, can we qualify with just one? Okay, because if my credit score is 850 and my partner, whoever I'm borrowing with, if theirs is 620, that's the score that's driving my mortgage insurance, pricing, eligibility, stuff like that. It's not an average.
Okay, first time home buyer. Everybody listen to this. That's a big deal. Now, some reason that wasn't in my brain. So they actually, if they're looking at both of you, two partners in a household, the lowest credit score is the one they're going to take and run with.
Right.
Wow.
Each has 3 credit scores. We've got the middle one from one person, the middle one from the other one. The lower of those two is what's going to determine your interest rate, your mortgage insurance, whether you're eligible for a program or not. So sometimes we may look at that and say, hey, this person, this borrower is driving things down for us. Mm-hmm. Maybe we could just take them off.
Right.
It makes a big difference sometimes. And even if they're both really good, I'm often looking for a way to try to get one or the other off, and here's why. If the borrower on the loan, the income that I use for qualifying is 80% or less than the area median income, there are significant pricing differences for those people. Let's say my credit score is 700.
Okay.
And I'm putting 5% down payment.
Okay.
And my income, the person's qualifying, is under 80% of the area median income.
Okay.
My interest rate will be better than the person who's got a 760 credit score putting 20% down.
Interesting.
Because there's little add-ons, adjustments to determining what your interest rate, and those adjustments get waived if you're under 80% of the area median income under certain programs.
So once again, this is just so much nuance in this that you have to look at every single detail, every single time, case by case, and find out what's the best way to get the best rate.
Yes, exactly. I've got 2 files right now where both people had great credit, both have good income, qualify easily, but we're stretching to qualify because we get a significant interest rate difference by being under 80% of the area median income. That's just the borrower's income, not the household income.
Correct.
Because USDA would be a different thing. Okay. This is just for conventional loans.
Conventional loans. So let's just say, for example, just so the viewers here understand this. So let's just say you looked at one scenario and one household partner is the one who had the good credit score and the good income. The other one would have dragged it down. They can qualify for the loan they desire just with the one.
Right.
Okay, so we take that one on. So at closing, what we would see is a mortgage or a deed of trust would be done just in that one name only. And then the deed, that still can be obviously joint ownership with rights and survivorship, and we can talk about those things later. But the deed can be taken to the property. The ownership can be taken to the property in both names, but the mortgage can be in the name of the one.
Right. In most cases, you can just have one person as the borrower, but you could have a spouse or whomever as the additional party taking title to the property on the deed.
Exactly. That makes good sense. All right, Jay, thank you so much.